On April 20th, 2020, the world outside was quiet, but inside a small apartment in Texas, the air buzzed with the hum of monitors and the faint rhythmic ticking of a wall clock. It was early morning, that soft, golden hour where the markets had just begun to stir. At his desk sat a trader, mid-30s, baseball cap pulled low, coffee steaming within arm's reach. His screen glowed with charts that danced in synchronized precision. Everything felt in balance. The strategy was solid. The market's pulse aligned with his own. For weeks, he had been riding a wave of confidence. His win rate was consistent, his system fine-tuned to perfection. That morning, as the sun edged higher, there were no signs of trouble, no major losses, no erratic price swings, just the steady beat of opportunity. He was locked in, eyes scanning, fingers poised. Every candle that formed seemed to whisper, "You've got this." But there's a cruel irony in trading. The danger isn't always in the obvious chaos. Sometimes it's in the quiet erosion of the mind. Hours passed, the coffee cooled, the tickers scrolled endlessly. Price noise, tiny fluctuations, meaningless in isolation, began to seep into his thoughts. It was subtle at first, like static creeping into a clear radio signal. He didn't notice his shoulders tightening, his breathing getting shallow, or the fatigue settling behind his eyes. Then it happened. A sudden move caught his attention. Sharp, quick, unexpected. His pulse spiked. His mind, dulled by the endless stream of micro-decisions, didn't run its usual checklist. He clicked. Position opened. A minute later, red numbers bled across the screen. He adjusted, chasing, trying to manage the loss. Another click, another loss. The rhythm was gone. The precision replaced by instinctive reactions. In less than an hour, the damage was done. Minus $240,000. The kind of loss that makes the room feel smaller, the walls closer. He stared at the screen in disbelief. The same desk, the same charts, the same rules. What had changed? Not the market, not the system. The only variable was the trader himself, or rather his brain's capacity to process, decide, and execute. Mental bandwidth is like the battery on your phone. At 100%, everything runs smoothly, but when it drops to 1%, the app's still open, the screen still glows. Yet everything lags, glitches, freezes. The machine is the same, but it can't deliver. In trading, your mind is that machine. Each chart scanned, each number calculated, each headline read drains a little more of your cognitive energy. It's an invisible meter, ticking down with every action. And when it runs low, clarity gives way to emotion. Discipline gives way to impulse. That morning, the trader thought he was making sharp, intentional decisions. In reality, his brain was in survival mode, cutting corners, reacting to shadows. By the time he realized it, the account had already taken the hit. This is the silent enemy most traders never see coming: the collapse of mental bandwidth. It doesn't matter how skilled you are or how sound your system is. When the bridge between your knowledge and your execution weakens, your edge evaporates. You can't fight the market with half a mind. And in those crucial moments, it's not the market that beats you, it's your own biology. Each morning, before the first chart loads, before the first market bell rings, your brain wakes with a fresh but finite charge. It's your invisible fuel tank, filled overnight while you sleep. This is your mental bandwidth, the sum total of your brain's processing power, attention span, and decision-making capacity for the day ahead. You can't see it, you can't hear it, but you feel it in the clarity of your thoughts and the speed of your reactions. And once it's spent, it's gone until you recharge. Think of it like the RAM in a computer. When you first power up, the system hums. Every application runs smoothly, screens transition instantly, and you can juggle multiple processes without slowdown. But as you open more programs, run heavier tasks, and keep the machine running for hours, the memory fills. It doesn't crash immediately. Instead, it slows. Delays creep in. The mouse lags, Windows freeze for a second before responding, and that instant responsiveness you relied on starts to vanish. In trading, your mind works exactly the same way. At 8 a.m., you're sharp. You scan a chart, identify a pattern, and make a decision without hesitation. Each action costs a little bandwidth, a few megabytes from the mental RAM. Deciding which markets to watch, that's a withdrawal. Adjusting your bias after a piece of news, another withdrawal. Managing an open position while monitoring three others, that's like running a dozen apps in the background while streaming high-definition video. The resources drain faster than you realize. Now, here's where most traders get blindsided. The depletion is silent. Your brain doesn't flash a low battery warning. It keeps running, convincing you you're still operating at peak capacity. But underneath, the processing power is fading. Your prefrontal cortex, the part of your brain responsible for logical thinking, planning, and self control, is running on fumes. It starts taking shortcuts, skipping critical steps, or outsourcing decisions to instinct and emotion. Imagine your phone at 1% battery. The screen still lights up. You can still open an app, but everything feels slower, clunkier, unreliable. You tap and nothing happens. You swipe and the response comes half a second too late. That delay is deadly in trading. A hesitation can mean missing an entry. A lag in judgment can mean holding a loser too long or closing a winner too soon. And just like with your phone, once your brain hits that point, no amount of willpower can magically recharge it. The cruel twist is that this depletion often happens fastest on the days when you need clarity the most. Volatile markets, breaking news, or complex setups burn through mental bandwidth at high speed. You start the morning with clean, crisp analysis, and by early afternoon, you're chasing shadows, second guessing yourself, and wondering why your trades feel messy. It's not the strategy that's changed, it's the machine running it. Mental bandwidth is the bridge between your skill and your results. You can have the most refined system in the world, but if your cognitive engine is sputtering, your execution will falter. And unlike capital in your account, there's no overdraft. When you run out, you're done for the day, whether you admit it or not. This is why elite traders don't just manage money, they manage mind power. They understand that every decision has a cost and that reckless spending of mental bandwidth is as dangerous as reckless spending of capital. They pace themselves, they protect their focus, and they reserve their sharpest mental hours for the decisions that matter most. Your edge isn't just in the chart patterns you spot or the risk management rules you follow. It's in the clarity and speed of thought you can sustain when the market moves fast. And that edge only lives as long as your bandwidth does. Every trade you take is powered not just by your account balance, but by the mental battery behind the screen. Treat it like the finite resource it is, and you might just find you've been sitting on one of the most overlooked advantages in the game. It's not the market that slowly drains a trader's account, it's the silent erosion happening between their ears. Every morning begins the same. You wake with your mental battery charged, ready to take on the day. But in trading, that charge is under constant attack. The irony? The most dangerous threat isn't volatility, fake-outs, or a sudden news spike. It's the slow bleed of cognitive overload, the hidden enemy that burns through your daily budget of mental energy before the real opportunities even appear. Picture a fighter pilot locked in a high-speed dogfight. Alarms blare, radar flashes. Every second demands a split-second choice. But the real danger isn't the enemy aircraft. It's his own brain, struggling to process too much at once. In that chaos, missing one key signal or hesitating for a fraction of a second can end the mission. Now swap that cockpit for your trading desk. Instead of radar pings, you have charts flashing. Instead of missile alerts, you have news headlines scrolling and Discord chats buzzing with conflicting opinions. You believe you're handling it all until you realize you've just taken a trade that violates your own rules. Here's the truth. Every choice you make costs energy from your daily budget. At 100% mental capacity, your decisions are sharp, calculated, deliberate. But unlike your phone, you can't plug your brain into the wall and recharge instantly. Every market scan, every level you mark, every alert you set, they all chip away at that reserve. Then come the curveballs. Unexpected news forces you to reassess your bias, cancel an order, or change your plan entirely. That's another chunk gone. By the afternoon, you're making trades you wouldn't normally touch, not because your system has changed, but because your brain's energy reserves have been quietly chipped away, trade by trade, click by click. Psychologists call this decision fatigue. The more decisions you make, the lower the quality of the next one. This isn't about weak willpower, it's biology. Your prefrontal cortex, the part of your brain responsible for logic, planning, and impulse control, runs on a limited supply of glucose. When it's drained, your discipline frays, your patience thins, and your ability to resist bad trades collapses. There's a famous study with judges making parole decisions. In the morning, prisoners had a 65% chance of being granted parole. By the end of a decision heavy session, that chance dropped to almost zero, not because the cases were worse, but because the judges were mentally spent. After a break or a meal, the approval rate jumped back up. Your brain works in cycles, and so does your trading performance. That's why the most important question isn't, can I trade all day? It's, where will I spend my energy for maximum return? Because not all mental strain is equal. Some tasks are worth the cost, others are mental money pits. The tragedy is that most traders brew their daily budget on low value decisions, scanning too many markets, reacting to meaningless price moves, engaging in endless online debates, leaving nothing for the high impact moments that actually move their P&L. If you've ever found yourself staring at a perfect setup late in the session and feeling too mentally foggy to pull the trigger, you've experienced this firsthand. Your brain may still be awake, but your decision-making capital is bankrupt. And unlike your trading account, there's no quick deposit. Once today's mental budget is gone, it's gone. The next session is your only chance to start fresh. The traders who last in this game are the ones who learn to guard that budget like it's their most precious asset. Because in a way, it is. You can rebuild an account after a drawdown, you can recover from a losing streak, but when you spend your mental energy recklessly, you can't get it back in time to seize the day's biggest opportunity. Not all mental strain is created equal. Some of it is the natural weight of the work itself. Some of it is junk you let creep in. And some of it, when used wisely, actually makes you stronger. In trading, these three forms of cognitive load, intrinsic, extraneous, and germane, are the silent forces shaping every decision you make. If you don't know how to tell them apart, they'll drain you without warning. Intrinsic load is the unavoidable difficulty of the task at hand. It's the raw mental effort required to do the job. In trading, that might mean reading a candlestick pattern, interpreting a new indicator, or doing a multi-time frame analysis that weaves in macroeconomic data. A simple price action setup on one time frame, low intrinsic load. A layered multi-market analysis during a volatile news cycle, that's a mental deadlift. You can't eliminate intrinsic load. It's the cost of doing business. But you can match the complexity of the task to the mental energy you have left in the tank. Attempting a heavy lift when your bandwidth is already low is like trying to run a sprint with a sprained ankle. You'll push, but the result will suffer. Extraneous load is the most dangerous because it's often self-inflicted. It's the noise, the irrelevant information, the alerts, the Discord pings, the flashing news headlines in the corner of your screen. These aren't part of the trade's actual difficulty, but they hijack your focus all the same. Imagine trying to execute a precise trade while your phone buzzes, your Twitter feed debates the next big move, and an unrelated email notification pops up in the corner of your vision. None of that helps you pull the trigger better, but it taxes your mind as if it did. The tragedy is that many traders confuse extraneous load with staying informed. In reality, it's bandwidth theft. Then there's germane load, the mental effort you spend making sense of what you're doing, learning from each trade, and integrating those lessons into your long-term skill set. This is the good strain. It's the deliberate reflection after a loss to understand why you missed the entry. It's reviewing screenshots to identify patterns in your setups. It's mentally simulating how you'll react next time you see the same market behavior. Germane load is tiring, but in a constructive way. It builds your trading schema, the mental blueprint that lets you process familiar situations faster and with less effort. The interplay between these loads is what makes or breaks your clarity. Start the day with manageable intrinsic load and a calm market, and you're in a good place. But pile on extraneous distractions, news feeds, chat debates, random alerts, and suddenly even a familiar chart pattern feels confusing. NASA's human performance studies have shown that high extraneous load makes intrinsic load feel heavier, even if the task hasn't changed. It's like cooking a simple recipe while someone blasts loud music, your kids ask constant questions, and the TV blares in the background. The dish itself isn't harder, your environment is. And here's the kicker. In trading, all three loads are constantly shifting. You might start with a low intrinsic load, add a spike of extraneous noise, then jump into deep germane reflection after a mistake, all within minutes. If you're not paying attention, you'll burn through your mental reserves without realizing it. The best traders learn to strip away extraneous load, pace their intrinsic load to their available energy, and lean into germane load strategically, so it builds skill without tipping them into overload. Trading doesn't just create cognitive load, it amplifies it, turning a steady weight into a crushing force. If cognitive load is like lifting a barbell, then trading is doing it in the middle of a hurricane. Every factor that makes the brain work harder in normal decision making is dialed up in the markets, and often all at once. The first amplifier is time pressure. In many jobs, you can pause, think, and revisit a decision later. In trading, a perfect setup can vanish in seconds. The market's clock ticks loud in your head. Every delay costs potential profit or adds to potential loss. This pressure spikes intrinsic load by forcing you to process information faster than your brain is naturally comfortable with. You're analyzing charts, executing orders, and calculating risk at lightning speed, all while a mental metronome counts down. Your mind burns more energy in minutes than some jobs require in hours. Then there's information volatility. Markets are not static, they are rivers of constantly shifting data. Price action that looks bullish can turn bearish on a single headline. Technical patterns form and dissolve in real time. Your brain craves stability, patterns it can rely on. Trading offers none of that comfort. Instead, it forces your working memory into overdrive, constantly updating its internal map of the market with each new data point. This perpetual reshuffling is exhausting, especially when layered over time pressure. The third amplifier is financial stakes. In most high cognition environments, chess tournaments, air traffic control, even surgery, mistakes can be costly, but rarely do they drain your personal bank account in real time. In trading, every decision is tied to real money. The emotional weight of possible loss ramps up extraneous load, because now your brain isn't just processing the trade, it's wrestling with fear, loss aversion, and the primal instinct to protect resources. Neuroscience calls this loss aversion bias, and it's been shown to hijack rational thought. In trading, it's like trying to solve a complex puzzle while a lion watches from the corner of the room. And then there's the constant vigilance requirement. Even in quiet markets, you're scanning for setups, watching open positions, monitoring news, and managing risk, often in parallel. This nonstop alertness creates task switching cost. The cognitive energy burned every time your brain shifts from one focus to another. Just like a computer switching between multiple heavy programs, your mind has to reload the relevant context each time, and the energy cost is steep. Even on days when nothing dramatic happens, traders often feel exhausted because their mental state has been wound tight for hours. When these amplifiers converge, a volatile session, big stakes on the line, time pressure to act, all three types of cognitive load, intrinsic, extraneous, and germane, spike simultaneously. In 2015, during the Swiss franc shock, even seasoned traders with rock-solid systems panicked, exited trades at terrible prices, or froze entirely. It wasn't that they forgot how to trade. Their cognitive load simply exceeded capacity. The brain's bridge between knowledge and execution collapsed under the weight. This is why trading can feel disproportionately draining compared to other complex activities. The market doesn't just demand your attention, it demands it now. It changes the facts while you're looking. It ties every choice to your wallet, and it forces you to stay on guard long after most people would stand down. The load isn't constant. It's a tide that can surge without warning. And if you're not actively managing that load, it will silently degrade your performance before you even realize it. The best traders know that in this amplified environment, mental energy isn't just a background factor, it's a core resource. They treat every point of bandwidth as precious, guarding it from unnecessary strain, timing their biggest moves for when their mind is freshest, and recognizing that when the hurricane hits, even the strongest cognitive muscles can only lift so much. Cognitive overload rarely arrives with alarms or flashing warnings. It slips in quietly, like fog rolling over a coastline. At first, you can still see the water, but soon the horizon disappears. In trading, this fog clouds judgment, erodes discipline, and sabotages execution without you realizing it's happening. The symptoms are subtle at first, but if you know what to look for, they're as telling as red numbers on a screen. The first symptom is impulsive entries. You see a sudden spike on the chart and pounce without checking your usual confluence points. In the moment, it feels like decisiveness. In reality, your brain, starved of processing power, is cutting corners. It skips the mental checklist because running it requires bandwidth you no longer have. The result? Trades that don't align with your plan, taken on a gut feeling you wouldn't normally trust. The second is abandoning risk rules. Maybe you've respected your stop loss level for months, never moving it. But today, you slide it just this once to give the trade more room. This isn't conviction speaking, it's fatigue. Your brain's self-control mechanisms are too drained to hold the line. That tiny exception often snowballs into bigger losses, and it's a clear sign your mental reserves are low. Then there's the habit of closing winners too early. Not because your target has been hit, but because your patience has evaporated. When bandwidth is depleted, uncertainty feels unbearable. Your brain craves the relief of locking in a gain, even if it means cutting your edge short. Over time, this slow bleed erodes your overall P&L as surely as taking losses. Another warning sign is repeating mistakes you thought you'd fixed. You've done the work, learned the lesson, even journaled about it. Yet here it is again, the same sloppy entry, the same over-leveraged position, the same late exit. This isn't regression in skill. It's your mind defaulting to autopilot behaviors when it no longer has the energy to consciously apply what it knows. Tunnel vision is another symptom. You fixate on one chart, one setup, convinced it's the only thing that matters, while missing broader market context. NASA calls this attentional tunneling. Overload forces you to cling to a single piece of information, excluding everything else. In trading, that can mean missing a clear reversal sign on another time frame or ignoring news that invalidates your setup entirely. Perhaps the most dangerous symptom is overconfidence. When mental energy is low, the brain sometimes responds by simplifying everything into black and white certainty. This setup looks good, so it must be good. The nuance and risk assessment that normally guide your decisions are gone, replaced by a false clarity that feels empowering but is often deadly. This is how traders blow up accounts in a single afternoon. One veteran futures trader once told me he noticed his largest losses almost always came after his third or fourth trade of the day, regardless of whether the first ones were wins or losses. On review, it wasn't emotion alone, it was fatigue. By the fourth decision, his reaction time had slowed, his risk assessment was fuzzier, and his discipline had cracked. The symptom wasn't one bad trade, it was the gradual decay across trades as his cognitive reserves drained. If you're honest with yourself, you've probably seen these symptoms in your own trading. Maybe not all at once, but enough to know they're not random. They are your mind's way of telling you it's running on empty. And like a car low on fuel, you can still drive for a while, but the performance is compromised, and the stall is coming. The traders who last are the ones who learn to pull over before the tank runs dry. Most traders see their P&L as a scoreboard for strategy, a reflection of entries, exits, and risk management. But buried in that data is a far more personal metric, your mental state. When you start pairing your trade results with notes on your cognitive condition, the connection becomes painfully clear. The days you feel sharp, alert, and unburdened tend to be the days your trading flows. The days you feel foggy, distracted, or mentally spent, they're often the ones where your account bleeds. I once worked with a trader who meticulously logged every detail, entry times, position sizes, outcomes, screenshots. After a rough month, we added a single self-rating column, a score from 1 to 10 on mental freshness before each session. Within 2 weeks, a pattern emerged. Trades taken with a mental score of 7 or higher had a win rate of 68%. Trades taken at 5 or lower, just 41%. Same strategy, same markets. The only variable was his available bandwidth. Here's the brutal truth. There's a dangerous myth in trading that once you're good enough, you can push through anything. That experience is an impenetrable shield. That skill will carry you no matter what. Cognitive science and countless blown accounts says otherwise. The brain is a biological machine. It has hard limits. When working memory is full, it's full. Past that point, even the most seasoned trader makes the same mistakes as a beginner, chasing losses, missing signals, misreading price action. Take Captain Chesley Sully Sullenberger, the pilot who landed U.S. Airways Flight 1549 on the Hudson after both engines failed. He's celebrated for flawless decisions under extreme pressure. But what's overlooked is how much of his response came from drilled muscle memory. By offloading routine steps to habit, he freed bandwidth for the unprecedented parts of the emergency. If he had to consciously think through every procedure, the outcome might have been very different. Contrast that with a 20-year market veteran I consulted for. One brutal week, he ignored a high probability short setup because he was too busy micromanaging a losing scalp from earlier in the day. By the time he looked back, the short had already run 300 points. His skill hadn't vanished. It had been sidelined. His bandwidth was tied up in emotional load and overanalysis, leaving nothing for opportunity recognition. Cognitive overload is the great equalizer. It flattens the skill curve, stripping away the advantage you've built over years. This isn't theoretical. In a 2010 study, experienced surgeons made as many errors as junior residents when performing complex procedures under high cognitive load. The pathways of skill were still there, but the bandwidth to access them was gone. The implications for trading are clear. No amount of chart time will make you immune to fatigue. If anything, experienced traders are more at risk because they tend to watch more markets, analyze more deeply, and shoulder more pressure to perform. Without actively managing bandwidth, your edge erodes over the session, and you don't even notice until the damage is done. This is why protecting your mental state is as important as protecting your capital. Your strategy may determine your theoretical edge, but your bandwidth determines whether that edge shows up in the real world. A clean, rested mind can execute flawlessly. A cluttered, fatigued one can't, no matter how much skill is behind it. You can't manage what you can't measure. Mental bandwidth may feel intangible, but traders who treat it as a measurable resource gain a decisive advantage. When you stop thinking of clarity as a vague feeling and start tracking it like any other performance metric, you create a feedback loop that can save you from costly mistakes before they happen. The simplest way to start is with self-assessment scoring. Before you open your charts each day, rate your mental freshness from 1 to 10. This isn't about mood, it's about sharpness. Did you sleep well? Are you free from distractions? Do you feel alert? Over time, patterns emerge. You might notice your win rate holds strong when you start at a 7 or above, but drops sharply at 5 or lower. That's not superstition, that's data telling you when to size down or even skip trading altogether. For a deeper look, consider the NASA TLX Task Load Index, a tool originally designed for aviation and medical fields to measure workload across 6 dimensions: mental demand, physical demand, time pressure, performance, effort, and frustration. Rating yourself during or after each session on these categories can reveal which type of load is hurting you most. Maybe your intrinsic load is manageable, but constant time pressure is what drains you. Or perhaps your frustration levels spike after losses, which then snowball into poor decision making. Decision count is another overlooked but powerful metric. Count every meaningful trading-related decision you make during a session, from choosing which market to trade to adjusting a stop loss to deciding whether to skip a setup. On heavy days, you might make double or triple the decisions of a light day, and each one chips away at your cognitive reserves. This is where you'll see that even small decisions carry a cumulative cost. Reaction latency, the time it takes to respond to familiar setups, is a more subtle measure. If you find yourself hesitating on trades you'd normally take instantly or double-checking details you usually know cold, that's a sign your bandwidth is thinning. It's like an athlete whose reflexes slow ever so slightly, enough to miss the catch or swing too late. One trader I worked with created a mental battery chart in his journal. He'd start each morning at 100% and deduct rough percentages for each mentally taxing event. Minus 5% for scanning a new market, minus 10% for executing a complex trade, minus 15% for managing a loss. By week's end, he could see exactly when and how his energy was being spent. The revelation? He was burning half his battery before the New York Open, leaving little left for the most profitable setups later in the day. A simple exercise to try. Set 3 alarms, morning, midday, and afternoon. When each one goes off, rate your mental clarity from 1 to 10 and jot it down. After a week, compare your scores to your results at those times. The correlation may shock you. The point isn't to obsess over numbers. It's to make the invisible visible. When you can see, in black and white, that your worst losses happen when your bandwidth score is low, rest stops, breaks, and simplified routines stop being nice to have and become core parts of your risk management plan. Because protecting your mental capacity isn't a luxury, it's a performance multiplier. Great trades don't start when you click the mouse. They start before you even open your platform. If your mental bandwidth is your most valuable trading resource, then your pre-trade routine is the firewall that protects it. Too many traders treat preparation as optional, something they'll get to if there's time. But in truth, that preparation is the first trade you make each day, and it's either a profitable investment in your brain's capacity and or an early withdrawal from it. The first step is workspace clearing. Every open tab, every extra chat window, every irrelevant news feed is an open loop in your brain, something quietly tugging at your attention whether you realize it or not. Clearing your workspace isn't just about tidiness, it's about shutting down mental background processes so your focus runs at full capacity. The more streamlined your environment, the more bandwidth you have for the decisions that matter. Next comes setting a focused watch list. Scanning 20 different markets might feel productive, but it's often just mental leakage. Your brain only has so much high-quality attention to give. By deciding in advance which markets you'll focus on, you eliminate dozens of low-value micro-decisions and keep your mental energy reserved for your chosen plays. The fewer distractions, the sharper your read. Then you define your triggers. This means writing down the exact conditions that will prompt you to enter a trade. The price levels, candle patterns, volume confirmations, or whatever fits your system. When you do this up front, you strip away the dangerous on-the-fly decision-making that eats up cognitive resources. You're not figuring it out in the heat of the moment. You're simply executing a plan you've already decided on at full mental charge. After that, confirm your risk limits. Decide your maximum daily loss and the conditions that will make you step aside for the day. Doing this when emotions are calm ensures that your risk management isn't subject to the whims of fatigue or frustration. It's the difference between building a lifeboat in port versus trying to build one while the ship is already taking on water. Finally, there's mental calibration. Before the first bell, pause to check in with yourself. Rate your mental freshness on a 1 to 10 scale. Note any distractions that might creep into your focus. Commit to rules that protect you when your bandwidth runs low. Some traders add physical rituals here. A deep breath, a quick stretch, or even writing a sticky note that says, "Trade the plan," and placing it in plain view. These small anchors can shift your mindset into execution mode. One currency trader I worked with added a powerful question to his checklist. Would I trust myself with twice my normal position size right now? If the answer was no, he wouldn't trade, not because setups weren't present, but because he knew his mind wasn't in peak condition. Over the next quarter, his win rate jumped by 11%, purely from avoiding low bandwidth sessions. A strong pre-trade checklist isn't just about saving bandwidth, it can actually increase it. By front-loading decisions while your mind is fresh, you free up capacity for execution under pressure. Because once the market opens, it will throw everything it has at you, and you'll need every ounce of mental clarity to respond. Most traders think the key to better results is making more good decisions. In reality, the secret is making fewer and making sure the best of them happen when your mind is at full power. Mental bandwidth is like a stack of poker chips. Every choice you make, no matter how small, costs you one. The tragedy is that most traders burn through their stack on low-value pots, chart hopping without purpose, reacting to every minor price move, tweaking indicators mid-session. By the time a true high-impact opportunity arrives, they're running on fumes. Strategic decision allocation is about knowing where to spend your chips. First, identify your high-impact decisions, the ones that meaningfully shape your P&L. These might be choosing which market to trade for the day, picking your A-plus setups, deciding whether to hold through news, or determining when to stop for the day. These deserve your freshest, clearest thinking. Everything else is either noise or can be automated, pre-decided, or cut entirely. Automation is one of your biggest allies here. Let alerts do the job of monitoring price levels so you're not wasting focus staring at every tick. Use position sizing calculators instead of burning mental energy on math when the clock is ticking. Set rules in your platform that execute automatically under certain conditions, freeing up bandwidth for the judgment calls that truly matter. One futures trader I worked with kept treating every price fluctuation as a potential trade. His journal revealed hundreds of micro decisions each day, most of them inconsequential. When we restructured his process to cut these by 40%, his profit factor nearly doubled. His strategy didn't change. His brain just wasn't fried by the time the real trades came. Sometimes the best trade is not trading at all. If you're down to 30% mental battery and a mediocre setup appears, passing on it isn't weakness. It's conservation. Think of it like ammunition in a long battle. Spending it all early on small skirmishes leaves you vulnerable when the decisive fight arrives. A simple litmus test. Before making any decision, ask yourself, is this a $1 decision or a $10,000 decision? If it's the former, automate it, pre-decide it, or ignore it. If it's the latter, make sure you're bringing your best mental self to the table. The market won't tell you when the day's most important choice is coming. If you've already spent your best thinking on scraps, you'll miss your shot. The pros understand that trading isn't about doing more, it's about doing less, better. By budgeting your mental energy for the moments that truly count, you protect your edge where it matters most. Most traders treat breaks as an afterthought, something you take when you're tired, bored, or frustrated. But if you wait until fatigue is obvious, you're already trading at a fraction of your capacity. The most effective breaks aren't reactive, they're preventative. They happen before your mental bandwidth starts to collapse, keeping you sharp for the decisions that matter most. The human brain operates best in cycles. Research suggests that our peak focus typically lasts 60 to 90 minutes before attention begins to decline. After that, performance drops, mistakes rise, and recovery takes longer. Smart traders structure their sessions around these natural rhythms, stepping away at planned intervals, even if they feel fine. The goal isn't to rest when you're empty, it's to refuel before you run dry. But not all breaks are created equal. The worst thing you can do is swap one form of cognitive load for another. Scrolling through social media, replying to texts, or diving into unrelated news still taxes the same mental systems you're trying to restore. Instead, the best breaks pull you completely out of decision-making mode. Step outside for fresh air. Stretch. Breathe deeply. Listen to calming music. Some traders keep a plant or small garden nearby and tend to it between sessions. Something tactile, slow, and grounding. One equity day trader I worked with used a simple reset ritual every hour. Stand up, walk to the kitchen, drink a full glass of water, and gaze out the window for 2 minutes without looking at a screen. He called it clearing the RAM. The ritual was short enough to avoid losing market awareness, but long enough to reset his mental clarity. His afternoon performance improved so much that he later added a 15-minute midday break away from the desk, which became a non-negotiable part of his process. The timing of breaks is as important as the content. Plan them during naturally lower volume market periods or right after executing a trade plan. If you take them randomly, you risk stepping away during an unfolding setup or returning to a rapidly changing market without mental readiness. Aligning breaks with your trading schedule makes them seamless rather than disruptive. Mental recovery isn't just about the minutes away, It's about the quality of those minutes. A 5-minute screen free pause paired with intentional breathing can restore more clarity than a 20-minute break spent doom scrolling. Think of it like active recovery in sports. You're not just stopping, you're actively preparing your body and mind for the next round. The traders who last the longest aren't the ones who grind the hardest. They're the ones who recover the smartest. Every planned pause is an investment in your future decisions, and in trading, your decisions are your edge. Most traders review their trades purely in terms of price action, where they entered, where they exited, what the market did. That's useful, but incomplete. If you want a true edge, you need to pair your P&L with your mental state at the time. The market doesn't just test your strategy, it tests your bandwidth. A post trade debrief is how you find out which days you were operating at full capacity and which days you were flying on fumes. Start by reviewing each trade in the context of your plan. Did you take it because it met your predefined criteria or because you felt pressure to act? Were your entries and exits deliberate or reactive? This isn't about self criticism, it's about identifying when your process held and when it cracked. Next, note your cognitive state at the time. What was your mental freshness score before the session? How did it change during the trade? Did you feel sharp and patient or mentally cluttered and impulsive? You might find that your losing trades cluster around moments of fatigue, distraction, or emotional load, patterns you can't see if you only track price data. Some traders use a simple traffic light system in their journals: green for trades taken at full clarity, yellow for trades under partial strain, red for trades made with low bandwidth. Over time, you'll notice that most of your high quality wins come from green conditions, while the reds drain your account. That awareness alone can help you avoid unnecessary losses. Then examine your decision quality. Were you sticking to your planned risk parameters, or did you move stops and targets mid trade? Did you double check before entering or rush in? This step is where you link execution quality directly to your mental condition, and the patterns are often eye opening. Finally, record your takeaways. If a certain type of setup consistently appears during low bandwidth moments and performs poorly, you might remove it from your playbook entirely. If certain recovery rituals, like a short break or mental reset, improved clarity mid session, note that too. Your post trade log becomes not just a record of market behavior, but a blueprint for protecting your own capacity. One index futures trader I worked with cut his monthly losses in half after 3 months of mental state tracking. He realized that 80% of his losing trades happened after his self rated energy dropped below a 6 and simply stopped trading when it did. His strategy didn't change, his awareness did. In trading, the market will always test your technical skill, but it will also test your cognitive endurance. A post trade debrief that links results to bandwidth patterns ensures you're improving both. Mental bandwidth isn't fixed, it's trainable, just like physical endurance. Most traders accept their current capacity as a given, when in reality, you can expand it with deliberate practice. Just as an athlete builds stamina through progressive overload, a trader can strengthen focus, working memory, and mental resilience over time. The first step is working memory training. This is the brain's short term holding tank, the space where you juggle prices, levels, patterns, and scenarios in real time. Tools like dual end back exercises, complex mental math, or memory card games can stretch this capacity. Even 5 to 10 minutes a day of targeted working memory training can make a noticeable difference in how long you can sustain high level thinking without feeling overloaded. Next comes focus stamina. Your ability to stay locked on one task without drifting is critical in trading. Practice deep work sessions on non trading activities, reading complex material without checking your phone, coding for an hour without distraction, or doing chart replay without pausing. The goal is to push the boundaries of your sustained attention, then rest, then push again. Over weeks, the length of time you can maintain peak concentration grows. Cognitive resilience is the third pillar. This is your brain's ability to bounce back quickly after stress or mistakes. Mindfulness meditation, breathing drills, and stress inoculation exercises help here. By training yourself to observe thoughts without reacting, you shorten the time between something went wrong and I'm back in control. A trader who can reset in 30 seconds after a loss has a massive edge over one who stews for 30 minutes. Physical fitness plays a direct role in mental bandwidth. Aerobic exercise increases blood flow to the brain, resistance training improves hormonal balance, and quality sleep solidifies learning. A tired, undernourished body is like trying to run trading software on a computer with overheating hardware. It doesn't matter how good the program is, the performance will lag. A trader I coached once described his mental bandwidth as a coffee cup that starts full but spills a little with every decision. Through daily memory drills, weekly long read study sessions, and twice weekly mindfulness practice, he expanded his cup over 6 months. By the end, he was able to handle the same market load with half the perceived stress, and his P&L became far more consistent. The key is progression. Start small, just as you would in the gym. Add 1 extra minute to your deep work sessions each week. Gradually increase the complexity of your memory exercises. Extend your mindfulness practice by a few breaths at a time. These micro improvements compound into a measurable increase in capacity. Trading will always test your limits. The difference is that with deliberate training, those limits move, and every inch you push them gives you more space to think clearly, act decisively, and maintain your edge when others are mentally tapped out. Most traders obsess over strategies, indicators, and market news, yet overlook the one asset that multiplies all others: mental bandwidth. Unlike a new setup or tool, it isn't something you add to your trading. It's the foundation that determines how well every other part performs. If you protect and grow it, the returns compound for years. If you neglect it, even the best systems will underdeliver. Think of mental bandwidth as the processor speed of your trading mind. Two traders can run the same strategy, but the one with sharper clarity, faster decision making, and better emotional control will always execute it more profitably. That's why you sometimes see skilled traders underperform. They're trying to run high performance code on a lagging machine. The compounding effect comes from consistency. Each session you trade with high mental clarity, you make cleaner decisions, avoid unnecessary losses, and record more accurate observations. Those better observations feed into sharper adjustments to your strategy, which in turn improve your edge. Over months and years, this creates a feedback loop where your process sharpens, your stress lowers, and your P&L grows steadily. Conversely, trading in a state of constant mental overload compounds in the opposite direction. Poor decisions lead to losses, which trigger frustration, which drain more bandwidth, which lead to even worse decisions. This negative spiral can wipe out months of hard-earned progress, not because your system failed, but because your clarity failed. The market rewards those who can stay present, focused, and disciplined longer than others. That's why mental bandwidth isn't just a soft skill, it's a performance asset. Like capital, it must be allocated wisely, protected from unnecessary drawdowns, and reinvested in ways that yield more over time. One trader I mentored began treating his bandwidth score like a P&L figure. If it was high, he'd allow himself to engage with more complex setups. If it was low, he'd scale back risk or skip the day entirely. Over 2 years, his account balance grew steadily, but the real shift was that his stress levels plummeted, and that freed him to think even more clearly. His bandwidth growth was feeding his account growth. The edge isn't in trading more hours or watching more charts. It's in showing up to every session with your mind operating at its peak. The market is a war of attrition. Most traders lose because they exhaust themselves before the real opportunities arrive. The ones who win are those who still have clarity, patience, and energy when everyone else is mentally spent. Mental bandwidth isn't a side consideration. It's your ultimate edge. Protect it, grow it, and let it compound, and it will quietly transform your entire trading career. This wraps the entire concept into a strong closing. It ties together the tactical, the measurable, and the philosophical sides of mental bandwidth while giving the reader a clear takeaway. What stands out in this conclusion is that it reframes discipline and focus as compounding assets, not just good habits. By putting mental bandwidth at the same level of importance as capital, you've made it clear that this isn't soft advice, it's structural to profitability. If this is going to be the final chapter of your series, I'd suggest adding a short, punchy anchor line at the very end, something that sticks in the reader's head after they close the page. For example, open quote, in the markets, your capital funds your trades, but your bandwidth funds your decisions. Lose either and the game is over. Close quote. That kind of line leaves them with a mental hook that reinforces the point you've been building for the entire piece. Do you want me to go ahead and draft that single killer closing line for you so it locks in the reader's memory?